Japan is the land of the rising sun, but the yen has been falling and the only thing going up is Japanese bond yields. But why does this matter for the global economy? Well, the other part of the equation is that Japan's gross debt is at 249% of GDP, the highest in the world. Now, recently the US did something it hasn't done for 28 years. It joined Japan to intervene in currency markets and buy yen. The official line was solidarity with a good ally, but no one really believes it was an outbreak of solidarity. The real reason is the US Treasury is worried about what could happen next. Firstly, a falling yen causes problems for the US. As the yen and other Asian countries fall, US exporters become less competitive. But the real story is that the falling yen means the Japanese may be forced to unilaterally intervene. That means selling their over $1 trillion of US Treasuries to be able to buy yen and shore up the value of the Japanese currency. Now, a strong dollar isn't all bad. It actually helps to reduce import prices and reduces inflation at a time when it's a real problem. But this benefit is not seen as enough to offset the much bigger problem about a falling yen. Now, for many years, the interest on Japanese debt was close to zero. So this high debt didn't matter for quite a long time. It was very cheap to borrow. But the thing is that in recent years, Japan has seen higher inflation and bond yields have risen as a result. This is long-dated 40-year bond yields showing a steep climb. And this does two things. Firstly, it increases the cost of Japanese debt payments. Secondly, it encourages Japanese to think about selling their US Treasuries and bring their money back to Japan to buy Japanese debt, which now gives a better return. And it is this which has really got the US Treasury worried. Japan is the largest foreign holder of treasuries, $1.2 trillion, 13% of foreign held debt. And as Japanese yields rise, it has already encouraged the selling of US bonds. TD Economics suggests that sustained selling of US Treasuries by the Japanese could add up to 50 basis points to US 10-year yields. And this explains why the US Treasury is in near panic mode. US 10-year yields hit an 18-month high last week of 4.75%, and the 30-year bond yield is near its highest level since 2007. Now, US bond yields are rising because of inflationary pressures from Iran and a very big rise in the US budget deficit. But the main point is that given all this pressure on US bonds, the US don't want to see any external pressure on pushing up bond yields even more, because US debt interest payments are already set to soar, and this means less money to spend on other government programs or higher taxes. So when the US suddenly appears to be helping Japan, it's really seeking to protect its own borrowing costs. And the thing is that although US bond yields are rising, Japanese bond yields are actually rising faster. And this shows the premium of US yields over Japanese yields. In late 2023, the gap was quite wide, a big incentive to hold dollar assets. And as that gap narrows, like in recent months, the incentive starts to reverse. But the curious thing is that despite the rapid rise in Japanese bond yields, the Japanese yen has been actually falling against the dollar. Usually, higher bond yields cause a stronger currency, because you get a better return when you hold interest-bearing bonds. But this is not happening. Now, one explanation is that because Japanese debt is so high, the Japanese central bank is artificially capping Japanese bond yields via bond purchases. If you look at debt levels and bond yields, you could argue that Japanese bond yields should actually be closer to 7% rather than 4%. So with artificially low Japanese bond yields, Japanese investors are still wanting to invest abroad, which of course weakens the yen. So can you solve this by propping up the yen through government intervention? Well, firstly, although governments have a lot of foreign exchange reserves, it's still a small share of the overall market, and the US was actually selling euros to buy yen, perhaps reluctant to sell its own dollar reserves. There was a small short-term bounce in the yen, but could it be maintained? Now, one argument put forward by Robin Brooks is that the yen is arguably still overvalued. Bond yields are suppressed by the Bank of Japan, so with domestic returns too low, there will be these persistent capital outflows. Why buy Japanese debt at 4% when there's an additional risk premium for buying debt where it's 249% in the case of Japan? So the argument is that no matter how much yen the central bank buy, it doesn't stop the tendency for capital flight as Japanese investors want alternative to the low-rate, high-risk Japanese bonds. Now, if you really wanted to protect the yen, if you really wanted to increase its value, the obvious solution is to increase Japanese interest rate from their current lows. But Japan doesn't want this because it will make their debt interest payments really high. Already, Japanese debt interest payments are expected to double from 10 trillion yen to 21 trillion yen in just a few years by 2029. Add in bond redemptions and total debt servicing hits 41 trillion yen, and that's around 30% of all government spending. And that's more than Japan spends on social security. And by the way, this is a phenomenon across Western economies. They're spending more and more on debt interest, which crowds out other spending. And even that forecast assumes that bond yields stay low. If yields were actually to rise to 6 or 7%, then the arithmetic breaks down and it's a real headache. But the problem for the US is that whilst it is worried about yen weakness, it doesn't like that solution of higher Japanese interest rates either, because if Japan increased their interest rates and stopped intervening, then some claim the Japanese bond yield would rise to 7%, then people would be selling their US Treasuries and buying Japanese bonds instead. So higher Japanese yields would cause higher US bond yields. And this is a really big issue because of the yen carry trade. Basically, people borrowed in yen when interest rates were zero, they invested in dollars, and they made a profit from that arbitrage. But if the Japanese rates rose to US levels and the yen stopped falling, then the yen trade would collapse, and there would be a massive liquidity shock. Investors would have to sell their US stocks and bonds to pay back their Japanese loans. So what would happen is that capital would flood away from the US back to Japan. So this is the trap. And the only really durable fix for the yen is higher interest rates, and higher interest rates are exactly what would do most damage to the US Treasury market. They can't have it both ways. Now, there are a few things to point out from this analysis. Firstly, Japanese net debt is lower than gross debt. That's because Japan holds overseas financial assets which earn interest. And one solution for Japan is that they could sell these overseas assets to pay back down the gross debt. And that would relieve the pressure on Japan's fiscal situation and also the yen. Also, another couple of evaluation points. 88% of Japanese debt is held domestically. So the risk of default, you could argue, is relatively low, with Japan's inflation quite low too. So although the headline figure, 249%, is quite high, it's not quite as extreme as it might seem at first glance. Also, not everyone agrees the yen is actually overvalued. If you look at using purchasing power parity measures, the yen is perhaps undervalued or fair value. Japan is actually running quite a large current account surplus. The weak yen has been pretty good for Japanese exports. The problem for the US, though, really is that you can't solve this problem of rising US bond yields by intervening in currency markets. The problem is much deeper than that. Fundamentally, the US faces long-term projections of a sharp rise in US debt levels because spending forecast to grow and tax will stay fairly constant. Up to now, the US has benefited from decades of high demand for US assets, and this has enabled the US to run large deficits at relatively low cost. But it's not just Japan thinking twice about saving in dollars, because China has been steadily diversifying out of dollars into gold. Now, in a crisis, demand for US Treasuries is supposed to rise. In this one, it hasn't, despite a supposedly glut of global savings. Now, Kevin Walsh has had a baptism of fire. Inflation is still running above target in the US, which normally means higher interest rates. But it's no longer just about inflation. It's about interest payments on the growing level of debt. And as the US is finding out, what happens in the Japanese bond market doesn't stay there. So the US is somewhat stuck. It doesn't want to let the yen fall, but it can't really afford the one thing that would stop it falling: higher interest rates. So for 30 years, Japan's debt was really someone else's problem. In fact, it wasn't much of a problem at all when interest rates were pretty much zero. But now things are changing. So it's pretty interesting to see what will happen next. Anyway, thanks for watching. Do subscribe. Let me know what you think in the comments. And also, if you have any questions, maybe try to answer those in future videos.